Our next ratio from chapter 20 was the debtors turnover ratio, and that looked at average debtors times 365 divided by credit sales, which in this case, if we put the numbers in, was 37 days. So how did we interpret that? We meant that on average at any one time the business has $9,000 of debtors, and on average it takes us 37 days to collect all amounts owing by those debtors. So based on the fact that there's always, or based on an average, there's not always, we're just going to assume, average debtors are $9,000 throughout this period. So at any one time, that's how many debtors we've got, and on average, it takes us 37 days to collect them. Then we have another $9,000 on average of debtors, it takes 37 days to collect them, and then 37 days for the next 9,000, and the next, and the next, and so on for the rest of the period. So interpreting the trend, if it went from 37 days down to 24 days. We said on the one hand that is a good trend because we're taking less time to collect cash from debtors, giving us the money to spend on other things. Secondly though, we might want to consider how did we lower it. Maybe we did it by giving out really high discounts, and that's good because we've got customers, but we're actually foregoing cash. We're going to get less cash in the long run, and it's also going to decrease our profit because discounts become an expense. Conversely, if the ratio goes up to 56 days, well, we'll say on the one hand, that could be bad in the sense that we are taking much longer to collect the cash from debtors, which could leave us with problems paying our bills if we don't have the money. On the other hand though, maybe it's because we're giving fewer discounts to debtors, and that's a good thing because it will again increase our profit and also increase the amount of cash we get in the long run. How can we make it better? Well, looking at the ratio from last year, we ended up with 37 days. So one way to increase it would be to have lower average debtors, but still sell as much on credit. So in other words, we'd be keeping really on top of debtors and making sure any day that it's not there's debtors outstanding that we follow up. And by doing that, we've managed to get average debtors down to 8,000. And if we do so, based on the fact we still sold a lot of goods on credit, 90,000 worth, we'd end up with a debtors turnover ratio of 32 days, which is an improvement. However, if we wanted to improve debtors turnover, but average debtors stayed the same, one thing we could do is generate more credit sales from them. So we could increase credit sales to 95 whilst having average debtors of 9, and again we'd end up with an improvement. This time the ratio would go down to 35 days. Specifically, if we get asked a question about strategies we can use to decrease debtors turnover ratio, we've got some tactics that we looked at when we looked at how to reduce bad debts back in chapter 9. So some things we can do is run credit checks to identify any customers with bad credit before we issue them credit, offer discounts for prompt payment, charge any interest on overdue accounts, send reminder letters and statements each month telling people what they owe. We can employ a debt collection agency if someone really hasn't paid us for a while, and we could also take legal action to recover the debt.